Welcome to what is the first of a monthly series of recordings on the Fact Series funds. I have with me here James Klempster, the portfolio manager of the funds themselves. James, over to you.
Thanks, Richard. The purpose of these vodcasts really is to reflect on the main performance drivers of the Factor Series fund range over any given month, how they're positioned, and then how we really see the world going forwards.
To that end then, James, last month, November, how did the Fact Series funds fare?
Yeah, the performance was good actually. It was between, in round numbers, 2 and 3.5%, depending on the strategy in the range, and that's not bad in an environment where the UK equity market returned about 3% in total return terms. So over the month, the fund's performing in line or even ahead of the equity market, clearly with less equity than 100% allocation, which is always a pleasing outcome. Over longer time periods, obviously, a month is pretty short-term period to reflect on performance. Since inception, the funds are up between sort of modest or medium and sort of high single-digit returns on an annualised basis, net of all fees.
Okay, a reasonable month, last month, I think it's fair to say. We saw equities in positive territory, we saw bonds, albeit not in dollar terms, but in local currency terms, positive territory. What then were the main themes you saw in November?
Well, if you just take a step back and look at what equities did and what bonds did, you think it's just another month really where equities and bonds drifted up. You had a return of about 2% from the global equity market, and low single-digit modest returns from global government bonds in their local currency. Slight area of inconsistency to bear in mind is that the US dollar was strong, so once you translate these foreign currency bond returns into US dollars, they actually lost value in US dollar terms. The equity markets only really woke up in the second half of the month. The first half was a little bit weak, but 2% is a reasonable return. There are some interesting regional differentials going on now. I mean, year to date, the US market, having hit a number of highs on the way to get here, is a full 10 percentage points ahead of the UK. There are some sector issues going on there, of course, energy being one, which is heavier in the UK. But again, it's interesting to see the kind of regional differentials we can see in the equity market. Emerging markets similarly had a pretty poor month. They were down in dollar terms over the 1 month. And year to date, they're really only about a third of the kind of return you've seen from the global equity market. So pretty meagre returns again from emerging markets compared to developed markets. If we turn to the fixed income market, government bonds and the high quality end of the credit spectrum generally did okay as interest rates pulled in a little bit. You've got a bit of capital gain there, nothing major. Moving down the credit spectrum to high yield, it wasn't a one-way bet. US did okay, Europe didn't do so well. And then if we turn to areas like the commodities market, of course, oil came off, gold was a little bit weak, so the commodity complex on the whole lost a bit of value over the month.
Taking what you've said there, James, in terms of the main themes, how does that translate in terms of the asset allocation drivers that led the Factor Series to their performance over the month?
It was actually quite a nice month in the Factor Series in the sense that the majority of positions actually were accretive to performance, and in multi-asset funds we've got a variety of different returns drivers built in. You'd expect some to always make money and some to detract from performance, but it was a pleasing month in the sense that the majority of holdings were actually positively contributing to absolute performance. We had, on the one side, we had the equity markets, which sort of drifted up over the month, as we've already mentioned. A decent weight in the UK market, as you'd expect, and despite the energy sector's weakness, the UK market did pretty well. Global equity markets did pretty well, again, particularly because sterling was weak, and if you translate a foreign currency into a weak local currency, that gives you a bit of a benefit. It's nice to have that coming into the portfolio over the last couple of months. We had a period last year and to an extent this year where sterling was strong, and that actually provided a headwind to performance, and now that's sort of coming out in the wash and giving us a bit of a tailwind for our foreign exposures in the fund. The things that detracted mainly were elements of the portfolio that were exposed, I suppose, to this negative energy story. Emerging market bonds, emerging market equities, both drifted off in sympathy with the oil price as much as anything else. And also Kopernik, our contrarian manager, has a decent exposure to energy-related counters, and as a result that detracted from performance as well. Elsewhere, the fixed income markets, we saw yields crunch down slightly more in developed market government bonds. That added to performance where we hold duration or interest rate sensitivity. And elsewhere in the credit spectrum, investment grade, added value. High yield, we're in the US, which added value. And then in the convertible debt market, also, and loan market, we saw some modest positive returns.
In terms of current positioning, James, have you elected to make any changes in, say, the last fortnight or so?
We haven't done much in the portfolios over this last month, really. In terms of the factor series, we're confident that we're nicely positioned in the sense we're broadly diversified in terms of the risk factors in the portfolio, and we think we've got a decent allocation for what we expect to come in the markets going forwards. Our realised volatility is pretty low, and that's a pleasing outcome, and we expect to retain that sort of lowish volatility profile compared to, for example, our peer group in the market. So in terms of what we've got presently, we've got a decent allocation to equity in the 3 strategies. Obviously factor 3 has less than factor 4, which has less than factor 5. Within that equity allocation, there's a decent chunk in the UK. Then there's sort of diversifying global holdings around it, emerging markets and infrastructure as well, to bring a different sort of set of return drivers into that equity bucket, if you like, in the portfolio. In the fixed income part of the funds, we try and be as low in government bonds as we can. We think they are overvalued. We don't think there's going to be an immediate sell-off in government bonds, but we do think they fundamentally appear bad value on a 5-year view, so we'd like to be underweight there. We'd rather be taking positions in the credit market, investment grade credit, high yield, and convertible debt, for example, where we'd like to take advantage of better opportunities on a relative value basis compared to government debt. Elsewhere, we've got a small cash balance, which is, again, a sort of relative value position compared to the government bond market. We think it's cheaper, but also it's a store of dry powder, something we can put to work as and when volatility rears its head again in the markets.
And finally then, James, I guess everyone wants to hear, looking forwards, we're moving into 2015, there are forces at play in the markets. What are you personally seeing?
It is an interesting time for us as multi-asset investors. There are clearly a number of risks emerging that perhaps we weren't so concerned about 6 months ago. Slowdown in Europe, Japan's still looking a bit shaky, China's clearly not doing as well as perhaps people in the markets had hoped. But then I suppose looking at China as an example, China's disappointing in terms of its GDP growth, but the Shanghai Composite has produced a positive return 7 months in a row. So it's just a salutary reminder to try and divorce the investment decision from the economic decision. They're related, but they're not interdependent in a sort of a one-for-one basis. So looking forwards today, we see a world where equity markets aren't particularly cheap anymore, but they're no means are they expensive. And in a world awash with liquidity, in a world where government bonds look very expensive to us, equity markets still could be a decent return driver in the portfolio. Having said that, it's worth remembering this last sort of 3-month period where volatility has increased. That's much more akin to the world we expect to see going forwards. We think we've had an artificially low volatility environment, and that is not going to continue into the future. So expect volatility, expect the occasional market move which is adverse, but use those opportunities to add to positions that you think fundamentally are cheap on a 5-year view. Avoid obviously things that genuinely lose you money that you can't make back, these permanent impairments of capital, and rather, don't just run away from volatility because it's a scary number. If it is an opportunity, embrace it, take a decent long-term view and build it into your portfolio. The best way to avoid too much volatility, which is something we all try and do, stay diversified, don't put all your eggs in one basket, keep a nice broad mix of returns and risk drivers in any given portfolio. Don't start to believe too strongly in any one investment case.
James, thank you very much.
Thanks, Richard.